Good morning to one and all of you. Welcome to the webinar by Anderson in the UAE, where we are open to discuss and get into the details of the recent amendments in the UAE VAT law. My name is Devina and I lead the marketing efforts of the firm, and we're going to kickstart this webinar. We have people joining in, but we'll simultaneously keep admitting them in at the webinar. Before I start and I invite my guest speakers in board and to sort of get into the details, understand the different changes and explain us different ways in which we can actually start implementing them already. Here's the agenda that will give us a brief about how today's session is going to actually come along. We'll start off by discussing the changing landscape of the region, specifically UAE. We will continue by discussing the critical aspects that we need to consider, specifically about the UAE VAT law changes. And moving on, we're going to sort of exactly show you or tell you how these changes can actually be implemented. That is the way forward. Before we start, I would want to sort of give an introduction about what is Anderson in the UAE. So if we move on, Anderson Tax was founded by the United States in the year 2002 by our former Arthur Anderson tax partners. The Anderson US is the founding member of Anderson Global. So the approach, the idea of Anderson is to actually have and extend our global reach so that we actually are able to give the best-in-class services to all our clients across. The main reason of why we are talking about all these changes, the main reason of why we want to make sure that these changes are well communicated to our clients is because we want to provide those services, not just do the consultation for you, but also keep you up to date about everything that's happening around in the tax landscape of the region. We specialize in advisory and consultancy for direct and indirect tax. Of course, the conversation is about VAT, but we can't stop talking or speculating about corporate tax that is going to come up next year. So we are here to sort of provide you services for everything that is taxed, be it indirect, be it direct tax. We deliver a range of value-added services, and of course, my colleagues who are going to be coming up next will discuss more about VAT, the services we offer, and of course, whatever the taxpayers are expected to do given the current changes. We are all about increasing our global presence. With the vision and the idea of our leader, Mark, he has been expanding throughout the globe. We have presence in more than 380 locations in more than 170 countries and counting. That's our aim. We want to sort of make sure that the name reaches each and every business because we want to let each one of you know that we are available, we are here, we are your partners, and we can actually make things quite easy for you. So you can concentrate on your business and leave the rest to the experts. So I'm going to now pass it on to my speakers. My today's speakers are Anurag, he's our CEO, the leader of the Anderson in the UAE, the heart and soul of our firm. He is the one who's giving us the pure vision of where we want to be in the coming years. And of course, Gaurav Chugani, he's our tax manager, VAT and excise. He is a complete expert in both those topics, and he's going to throw light on a lot of the recent changes that have come up in the tax law and exactly what all is expected of all of you as taxpayers, as businesses coming from different industries. What is the exact procedure that should be expected out of each one of you? So without further ado, I would like to start the webinar, and over to you, Gaurav. You can take up, continue on, and I'll be back in and out as and when needed by both my speakers. So over to you, Gaurav. Thank you.
Gaurav, you're on mute.
Thank you, Devina, for the introduction. We are here to decode the recent changes which are there in the UAE VAT. And the UAE VAT was implemented in 2017 by the Federal Decree Law number 8, which has been replaced by Federal Decree Law number 18 in the 2020. So this law was published in the Gazette on the 28th of September, which was available in the public domain with everyone on the end of October 2022. This law will be effective from the 1st of January 2023. So there are few changes which may have far-reaching implications. There are few minor language changes in the law which may or may not have that much implications. So we will discuss each and every aspect. We'll try to give you a 360 overview of the changes in the law. And we start with the definitions. There are few definitions which have been recently included, which are clarificatory in nature, like pure carbons, which basically is an expansion of the in Article 48 in reverse charge. There was a need for this definition to be defined. So pure hydrocarbons are those elements which have only purely hydrogen and carbon dioxide, nothing else. So these are the only two elements which should be there in the component that will be defined as a hydrocarbon. Relevant charitable activities have been defined. Apart from that, tax evasion, tax audit, tax assessment, tax procedural law, voluntary disclosure is replicated from the tax procedures law, and there's no change. It's just that they have brought these definitions in the UAE VAT law for more clarity and for completeness purpose. The definition of business, which is defined in the UAE VAT law, has been a bit amended, wherein vocational services have been included. So that could maybe include vocational trainings, which we are providing to intercompanies. Definitions are there. We will discuss about the definitions as we go through. And we moving forward, we are going to the main changes which are there. So there's a change. So basically what we have defined is that the entire session is defined as per the articles. We'll move as per the articles. Like there are changes in Article 5, 7, then so on and so forth. We'll move in that sense only. So first, there's a change in Article 5 on the supply of goods. The supply of goods, initially they had mentioned that there could be a supply for between two people for a supply on a later date. There's an amendment in the law which says that if there is a contract between two or more person for a supply on a later date. So, Anurag sir, if you could just give an
Yeah.
example and to elaborate the
So,
entire scenario.
good morning, everyone. I think it's very important to understand, we are living in the UAE, and the real estate is always a cornerstone of the economy in the country out there, besides oil and gas. We have seen in the past there was certain scenarios, which was preventing a particular transaction to be fall within the supply of goods. Considering a scenario where exactly you have one of the party which is selling a land. And then there's a buyer who buying this particular land, and there's a third party into it who's constructing, let's say, a structure over it. In this scenario, what is actually happening around? There's a tripartite agreement itself built in, and the title to the goods will be transferred as and when the goods, when the structure is basically erected out there, and that could be like between 2 years or 3 years or maybe more than 3 years time out there. So what should effectively considered as date of supply? First of all, is this contract considered as supply of goods? So that clarity was not there. I think with this inclusion of two or more person into the definition itself, now these kind of contract will fall within the picture of supply of goods. So when the supply of goods triggered, then we get into the form of, okay, what is the date of supply? Is it fall within the continuous supply, or it is going to fall within the supply as per Article 25, right? Because that's what need to be seen as per the supply of goods definition. As soon as you enter into a contract, that fall within the supply of goods. So implication is far largest of this particular inclusion into the picture, into the law, and that is what we're going to analyze as we're going to get into the date of supply provisions ahead.
Yes, moving ahead. So this was a dry topic. Now we are moving to the better topics. There's a change in Article 7 as well. Article 7 basically speaks about transactions which are not considered as supplies. Example, vouchers, supply of vouchers, or transfer of business as a going concern. The law has given the power to the executive regulations to include more examples of out of scope supplies or supplies which are not considered as supplies for VAT purposes. So there's a open window which has been given to the executive regulations.
Now,
Because
essentially,
changing,
in this
because
particular example, if I can narrate out there, we have seen over 5 years what has initially happened, and the reverse charge get into the picture came into the things. And when the oil get traded out there between the two parties, it becomes zero rated. So is become the gold. The gold get into reverse charge situation when the B2B transaction happens out there. Similarly, similarly, there can be other scenarios in various industries where the transactions between the two parties happening at arm's length price, and it creating an administrative burden in terms of reporting, making a payment, and taking the input, because in other parties, in many cases, it create a refund situation out there. So what the FTA's outlook in that relation would be is that they can add certain more instances where the transfer or the supply of the goods and services between the two parties is at arm's length, and it does not create any sense for them to tax that. So one party collect the tax and make the payment. Another party, on the contrary, immediately in the next period take a refund out. So the entire process of making a payment and taking a refund out there, creating a lot much administrative burden for people. And when the transaction size is really, really significant, and it can be sometime at a point in that it's difficult to articulate such kind of transactions. So they wanted to give administrative convenience to people at certain date when they realize, look, in a particular industry, there's a need of putting together special cases out there.
Correct. So basically, changing the law is a difficult process. It has to go through a lot of process wherein the cabinets are involved. And changing of executive regulations is a much simpler process. So the power has gone to the executive regulations, and if there are any additions for any out of scope supplies, it will become easier. Moving forward, there is a great change which has come in the exception for registration for VAT. Previously, non-registered persons who are making zero-rated supplies could go to the FTA and obtain a exception from registration. Now there is an amendment in the law which says that even people who are registered, they can also approach the FTA and ask for a sort of exception wherein they don't need to register for VAT. However, whether they are registered or they are not registered, they have to ensure that at all points they are providing zero rated supplies. And if there is a change in the business operation, or if there is a change in the entire business supply chain, and if there is even a single dirham worth of transaction, which could be 5% or any other supply like that, then the exception could be challenged and be revoked by the FTA. Uh, the FTA has also retained the power that if there is a ineligible person who's got this exception, FTA has the right to recover the taxes and levy administrative penalties. So most of the zero-rated companies like healthcare suppliers and all medical suppliers, they could have a far-reaching implication if they have already taken an exception and they are providing other supplies as well. Anurag
Now,
sir.
in this case, I can tell you, like, essentially there's a lot many international companies that may fall within this particular ambit, because if we see that a lot of rep offices of the foreign businesses are registered here, and all what they do at the moment is like recovery of the expenses from their headquarters. Or maybe we can see there are a number of global organizations which is basically put an office here which just to manage things, and their all contracts are run from an overseas, like shipping, for example. Shipping is there, and a lot much broker driven businesses are there, reinsurance businesses are there, which is basically nothing but they do that, they deal with outside parties, and most of the supplies are zero rated. But what happens in those scenarios, you always have a reason that certain sort of services where the place of supply is in the state, those are the things that they need to consider. Marketing related expenses, in what context that marketing related expenses has been expand in the UAE itself, in the state. So all these organizations need to really continue to evaluate at what stage they become basically need to charge standard rated supply, because standard rated supply is in relation to looking into provision of Article 31. So whether it fulfill the condition of Article 31. Does it fall in any situation, any circumstance in Article 31(3), where exactly the benefit is passed on to somebody within the UAE itself? So all the businesses which is subject to zero rated, they need to understand one thing, that they are always on the watch list of FTA, and those kind of circumstances, scenarios are always analyzed and put together a situation where they wanted the taxpayer or the registrant to substantiate that eligibility, that they can continue to be eligible for exemption from the registration, or they continue to be zero rated. So We have seen in many cases that such kind of transactions are presumed all the time. We presume that as and when we receive the money from a foreign party, it always eligible for zero rating. But that's not the case in all the circumstances. We need to see the context of the transaction which is entered between a party within the UAE, although you have a rep office or your branch office or whatsoever. The moment you do a transaction with your foreign party, which could be your related party or could be an outside party, you always need to see the context and the context of supply in that particular contract to understand the eligibility under Article 31 of zero rating. So it's far-reaching impact, and I think FTA has taken that view that they given the power to themselves to challenge these initial exemptions that have been provided out there. So it's far-reaching impact. I mean, all the businesses should definitely watch Outlook, essentially all the supply that they are putting together in box 4 as zero rated.
Yes, moving ahead, there is a change or an update in the deregistration of VAT also, wherein the FTA has strictly said that they have a right to deregister any person who is harmful or who is actually impacting the integrity of the tax system. Which means that there are few people in the past, they have noted that there are few people who are issuing tax invoices and they are not paying that to the FTA. And in the entire supply chain, that flow of taxes there, but ultimately that is not being given to the FTA. There are few suppliers, very small suppliers who are doing that. So to protect the integrity of the tax system and the flow of the tax within the supply chain, they may consider a person uh, which is not meeting the criteria and they may register that person. Second thing, the FTA also reserves a right to recover the due tax and levy administrative penalties even after registration. So they have kept that option available for them. And this is a thing that most of the people they say that okay, fine, I'm deregistered right now, I am tension free, I don't need to maintain records, I don't need to substantiate things. But this amendment which is there, which says that the FTA still has the right to recover due tax and administrative penalties if there are any.
No, I can give lot of examples in that relation. So the case one where FTA can deregister. Now there are a lot of trade which is happening that people, the small traders, they export a small piece of shipment to, let's say, neighboring country, which could be within the GCC itself. And then what they do that they basically give this entire thing to a particular person who's a shipper basically, and shipper then further takes all these goods out there in his in his personal name out there. So what has happened now? In order to be eligible to claim this entire thing as export, you need to have exit stamp, you need to have exit certificate, and so on and so forth. Now, besides that, what people do that, I mean, certain practices have been noticed out there. So they sell these goods to one person, and then one person takes these goods out there under one single, name, which means consolidation itself, and then exporting it out there. But in practical all scenarios, all these goods have been meant for export. Now, such kind of people, what they were trying to do that they get this 5% VAT charge, and then they get recovery of these VAT where it is not intended. Such kind of scenarios are not intended to be right within the tax preview, and they're considered always a tax evasion. So that is like one example that I can give out there. Today, we see within the businesses out there, many businesses, deregister today. So how the deregistration process happens that either you stop making supply, or there are certain circumstances beyond which the business stop making supplies out there. So what the person required to do that is that you today you go and cancel your license, uh, get the things audited, and you get a cancellation certificate from any of the authorized, I mean, authorities out there, be it free zone or be it mainland itself, and then submit that certificate back to Federal Tax Authority, and there's a separate deregistration team who looks into the authenticity of document, they look into the validity of the case itself, and then they deregister. The case is done once the deregistration happens, but later point in time, the Federal Tax Authority realized in particular industry that there was a trade which need to be treated differently. Let's say, for example, we all know that about the case where exactly there was a double taxation was there, where the supply by a free zone entity within the mainland, where the title to the goods was transferred within the mainland itself, was happening within the UAE, and then the parties were doing the import on record was doing the reverse charge, and which later on clarified that actually says, look, double taxation is there, but then it's a double taxation, so one should be doing only the import of goods, so they should not charge separate invoice. But then scenarios were there, let's say, for example, trade of oil, which is subject to zero ration. But people generally charge 5% into this. Scenario could be many where exactly the tax have been charged, tax have been recovered without being eligible for it. The tax recovery is based on the eligibility criteria that is defined with respect to input, availablement. So if a party has done the transactions which was subject to tax and they did not tax it, or they have recovered input where they were not eligible to recover the input, those kind of scenarios always exist. And so FTA given the right to themselves now that they can go and open a particular deregistered registrant and then apply the penalty again and again on top of that. So it is a very good amendment that they have brought into the picture in order to curb any sort of practices which create scenario for tax evasion or malfunction out there. So they're given a very strong power to themselves that despite you have deregistered, you're not out of tax ambit. So that is very strong provision. So when we look into that, when we look into that in a scenario out there with respect to deregistration, we shall definitely consider that deregistration does not warrant you an exit from a tax regime itself.
Sure. Moving ahead, there is a slight change in the date of supply. The change is clarificatory in nature, which is just to remove the surrounding ambiguity. Uh, if there is a seller and a buyer, and if there is a sale of goods on a basis where there is continuous invoicing and periodic payments, the date of supply in that case should be either the date of issuance of invoice or the date of payment or the date when whatever is written in the contract or the payment terms. And now the date of expiry of 1 year from the date the goods and services were provided is included. Previously, this was included as a part of a proviso, but now it has been included separately as a different clause. So this may not have an implication, but yes, this says that even if the goods have been supplied, the reporting of and paying of VAT should be there done within the expiry of 1 year. So there's not much change here, but yeah, it's a clarificatory nature change. Anurag sir.
Yeah, I think this is an important point that many times people were thinking that from a date of issuance of the invoice, then within 1 year they can issue an invoice and then get into the additional 14 days out there for with respect to reporting. So they have clearly articulated the date of expiry of 1 year from the date of goods and services are provided. So within that 12 months, you need to do that. You don't have additional window of that 14 months to issue invoice, which means people are taking 13 months. In a case that I can within the 1 year completion, I can issue invoice for 14 days. So that 1 month grace is also gone. That's how I see it. Basically.
Moving ahead, there is a different change in the plate of supply, wherein place of supply for import and export, wherein there is a continuous supply as per Article 26(1), and the ownership is getting transferred. So there are three conditions to it. If there is a contract for periodic payments and consecutive invoicing, and there is a transfer of ownership in the UAE, then that could be treated as a import or export transaction, which are supposed to be reported in the UAE. Companies transferring ownership of goods in the UAE may have implications even if the goods have not been physically located in the UAE. So now example, if there is a movement outside UAE, but the ownership is getting transferred here in the UAE, could also be treated as a zero rated export supply. Alternatively, if there are overseas suppliers supplying goods to customers in the UAE under a sort of a periodic payment and a consecutive invoicing scheme, then they could also have an implication if the ownership is getting transferred in the UAE mainland. So this could have an implication. What we envisage is that there's a public clarification which would come in to explain this in detail. Generally, what we have seen is that whenever there is a change in the law, there is a public clarification which follows within a span of 1 or 2 weeks, which is clarificatory in nature. So we're expecting a lot of clarity on this, and this could have far-reaching implications on many businesses. Anurag sir, we would like you to highlight few instances.
So essentially, in the business, when we talk about the place of supply is in the state when in respect to the goods which is export in nature. Now, what happens when we look into the goods which is export of goods is like continuous supply in industries such as oil and gas, steel, coal, the material which is required in terms of like any sort of structural building that is happening outside, where the supply is happening. And essentially we have seen in the COVID time there was like a lot of goods with respect to in healthcare industry have been moving from one location to another. I mean overseas out there. In such kind of situation, what has happened that the contract is entered once, and as and when the delivery of good happens, it is considered. Now when such kind of continuous supply happening against a single contract, right, that has significant implications in here. And I assume that when the FTA wrote particular this provision, they tend to have an implication on basically the goods which are in consignment in nature, which is a drop shipment situation out there. So they've tried to come up with a provision to cover such kind of scenarios where the goods have been moved out for a temporary period, or they're going into a particular work out there. So I at the moment, if you see that essentially when we're trying to send the goods out there, what we need to do that, although they are temporary in nature, like moving out for certain period of time, but all what we need to do that we need to create an exit document for that goods because it's going more than 6 months, and it could be multiple equipment and multiple goods out there to be sent out of the country from UAE itself for a period of time. And they're also always defined as supply of goods, because there is no provision at the moment in custom which can allow you to have a good outside the country more than 6 months. So there are further clarification which required to be discussed in this particular context, that what is the preamble and what is the context of this particular provision, and how and what kind of industries they are targeting on that. But I assume that essentially from a perspective that continuous supply are basically those goods which is like against single contract there are multiple supplies around it.
Correct, sir. Moving ahead, there is a remarkable change in the residence of agent. So this may also have a far-reaching implications on many principals who are located outside UAE. So previously, the place of residence of agent was equal to the place of residence of the principal. Now the words have been interchanged. Now the place of residence of principal is equal to the place of residence of agent. Okay, this will happen only when these two conditions are satisfied, or either of the two. If the agent is negotiating and entering into agreements in favor of the principal in the UAE, or if the agent is maintaining stock on behalf of the principal in the UAE. Now, typically what happens is that there are various brand owners located outside UAE who have agents over years or distributors over here, and they are sole selling agents and distributors. So in that case, what happens is that they reserve a right to enter into contracts in favor of the principal, and they also maintain stock in the UAE. Previously, the place of residence for agents used to be the place of residence of the principal. Now it's become reverse. The place of residence of the principal is equal to the place of residence of the agent. So effectively, the place of residence of principal will be the place of residence of the agent only.
Now, I'll just add to this, Gaurav, actually,
Yes.
we all are tax professionals. So in the tax world, we have understood the concept of, service fee or agent fee itself. This implication and this change brought the same concept from an corporate tax standpoint in the VAT itself, saying that any foreign party which predominantly perform and do the sort of work and supply within the state, they've been considered to have a place of residence within the country should they fulfill these two conditions which you stipulate out there. Now, this definitely has a far-reaching impact, I will say, from a standpoint of tax, because all these international players, I mean, UAE is a country where a lot of people they are doing activities. I mean, the business they are performing the business ongoing basis itself here through an agent and through an associate model out there in the UAE. And they until now they were treating that all the goods have been imported in the name and all the invoices have been issued under the associate agent or the broker's name out there. Now they need to understand from a VAT standpoint now whether whether they require registration within the UAE or not. So this definitely will impact a major client base and major businesses out there, which is operating within the UAE through agent or associate model, and they will be required to register. Should they fulfill these conditions out there. I mean, in that case, so they can't just bypass registration now. And recently we've taken a study. I mean, across 65 countries for one of the business out there. Now, the business was predominantly, providing certain sort of services as a mediator between the two parties. So it was buying on behalf of the customer and getting the goods delivered directly by the seller to the buyer. But they were facilitating all these services in different countries out there. So when we look into the registration threshold and criteria in different part of the world across 65 countries, the majority of the countries mandate registration. Majority of the countries. So why this majority of countries mandate registration? Because the moment you take any economic activities under a particular country, you can't run out of tax on it. So you have to have a tax. Otherwise, you need to have a mechanism whereby the people who are registered on their behalf, they should also take a hit of the expenses that is undertaken in relation to that particular activity. Because what has happened, the essence of VAT, if you see that, it's pass-through impact. Now, when the pass-through impact happens, what happens in this pass-through impact? A lot of people also take the input. Though the supply is not happened here, but so the economic advantage of that particular activity is not taken within the UAE itself, and then you take input in that relation as well. So idea to curb these practices is to bring that international players into the ambit of taxation within the UAE itself. And I believe this will really, create an impact on the global businesses, which is performing through an associate PE model.
Correct. Moving ahead, the value of supply for team supplies have been included. So earlier, the value of supply for normal supplies and team supplies used to be the value either at the cost of the person who's eligible to claim the credit. But if the person is not eligible to claim the credit, it should be the market price. Now, just giving you an example, this has been included in the updated VAT law, wherein that if there is a deemed supply with a related party, and that related party is eligible to claim the input tax, in that case, there's no loss to the government. Even if the transaction is happening at a cost price, it is no loss because the other person will claim it, and again, he'll further, maybe if he's eligible, he will charge. The supply chain would be there. There's flow in the entire supply chain. However, if there's a team supplies in relation to a related party, and the related party is not eligible to claim either in complete or maybe in partially, in that case, the transaction has to be executed at market value because there would be a leakage if the supply has been done below cost or at least at cost. So this is a remarkable change which may have implication on group of companies which are doing intercompany transactions or group of companies doing deemed supplies within their group.
No,
Anurag
I
sir.
think I think important thing here to see the critical cases, especially in hospitality business, where we are, doing a lot of business development related expenses on which, we are not charging anything. It's considered as a deemed supply. So let's say, a guest comes in to my hotel and I offer them, a complimentary breakfast. that person in an individual capacity can't recover the VAT on that. Now, until now, the businesses were thinking that the cost is a price on which they can pay the VAT. Now, going forward, effective from 1st Jan 2023, it has to be market price. Second example that I can narrate here is the gift automobile, for example, or real estate. Again, I'll take example real estate. So many developers, when they sell the property to attract the buyers, what they bring out this scheme that if you buy an apartment, you get a an SUV, or you can get a luxury car out there. Now that luxury car, they can't recover the VAT. So until now, all these luxury cars, let's say somebody book 50 cars for 50 residential properties out there, you get along with it, and they were recovering the VAT in relation to that as a business expense. But now, since that real estate company which is selling the residential property, and they're also renting out there, so there's a mixed supply which they have to proportionate certain expenditures. So this is considered again a deemed supply in relation to that, may consider a deemed supply, and then there may be scenario where they may not be able to take the input. Third scenario is like the raffles, you know, raffles that is coming out there. So many malls during the very festive seasons out there, they issue a lot of draws, and many other companies do a lot many draws out there where they take it particular good, and then in those relation to those goods, consider deemed supply again. It is going to an individual. So in those scenarios, the recipient of the good will not be eligible to take input in relation to the goods that is getting. So this is again considered as a deemed supply, and against which the VAT in your particular return in which you are undertaking this particular activity in the period should be blocked, and you should pay the VAT at the market price. So these are quite a few scenarios. Likewise, there can be many more scenarios out there which we need to see that. So essentially, the moment you do any transactions where you're not charging any consideration in relation to supply, you have to be very careful in terms of evaluating that as to what price you should be paying the VAT on a deemed basis.
Moving ahead, there are few minor changes in zero rating. This change is also clarificatory in nature because practically what we used to see is that import of qualifying means of transport or import of qualifying vehicles for rescue or import of preventive healthcare goods and services were treated as zero rated. But it has been clarified now that import could be also considered. Previously, the word supply was used, and technically, if we see the word taxable supply includes import, but now they have explicitly said that supply as well as import both will be considered.
Yeah,
So
I think it's important nature, very important, essentially for shipping and aviation sector, because until now they were receiving a lot of goods which were very hard to track. I mean, essentially look into the aviation industry for that matter. They receive lot of spare parts, lot many spare parts on daily basis, and there's a huge amount of that. To track those goods were very difficult for them. But as industry practice, everybody was doing that reverse charge, at zero rate, um, essentially in that context. So FTA brought more clarity by adding the import, because there are a number of clarifications that have been raised in this particular topic to FTA, although it was very clear, because essentially when you do the reverse charge, you have one side sales and one side purchase. So if the sales as zero rated, then purchase has to be at zero rate as well. So they brought more clarity into this. So it's more of a clarificatory nature, and that's how I would say that.
uh, just to add here, there could be a possibility that the zero rating now currently, due to default, those zero rated transactions are populated in the box 6 as 5% transaction. But there's a possibility that from 1st January, these supplies, if they are correctly classified and correct declarations are filed, these transactions will be reported as zero rated by the FTA automatically on the portal. That's something good, which we envisage. Moving ahead, there is a minor change in reverse charge mechanism. Like we had previously discussed, hydrocarbons have been defined in the law, wherein pure hydrocarbons mean chemical equations or components having hydrogen and carbon. and there is no other elements or there is no other chemical for a thing which is involved in this. So previously, any hydrocarbon was under the reverse charge mechanism. So there was a lot of confusion for lubricants service providers and sellers. They used to think that if the main supplier has not charged them VAT, they will also not charge VAT. There was a confusion in that. So it has become more clear right now that pure hydrocarbon has been defined, and those transactions will be covered only under reverse charge mechanism. Basically, this is the domestic reverse charge mechanism. Second thing, there has been an amendment wherein previously they used to say that a declaration has to be taken from the buyer or the recipient saying that these will be resold within the supply chain and not been consumed. Now there's a update wherein they say that even if it is being used for production and distribution of any form of energy, the reverse charge would apply, provided a declaration has been taken from the recipient. The third thing is that the FTA may include more scenarios in the cabinet decision or maybe in the executive regulations to include domestic reverse charge transactions for importer of goods and services. So we can, like, there is a import of reverse charge mechanism on gold. We can expect few more reverse charge coming for natural resources in the future. So there is a window which has been opened right now. Sir.
Now, I would like to add here, like, in the industry, many scenarios were there. People were taking that if the goods have been used, to further process certain things out there, it was not subject to reverse charge initially. And what they were doing that, they were charging the VAT between them, between the parties out there. I mean, this one particular scenario was used to basically fund, basically. So one party recovers the VAT, although the transaction is subject to reverse charge. So what the FTA stand came into picture that just merely the goods have been used for the reprocess, the reverse charge still applies in relation to that, and they have rejected at one sense that the party who charged VAT, should repay that VAT to the party who paid the VAT itself. So basically, the buyer has to claim the VAT from the seller. They'll not get refund from federal tax authority. This is that, because the reverse charge mechanism is in place. So we have to, take this entire matter rigorously with the federal tax authority to establish the context in which there was like a slight, provision within the law which allows people to charge VAT. So what I wanted to convey message from here that if there's a transaction which is subject to reverse charge, there is no way that a seller can charge VAT 5% and not do reverse charge mechanism. Because again, when the people say the prudent concept, I will charge VAT in relation to that, you need to really be careful about it because the recipient of the good may not be eligible to claim refund in relation to the transactions which were subject to reverse charge mechanism. So it has to be very clear that these provisions need to be followed properly, and that's why they added this specific provision that even for reprocessing out there. Yeah, well.
Yes. Moving forward, there is a great amendment in the recovery of import tax credit. So this would have a far-reaching implication on all businesses. And the amendment is like previously, there was a provision in the law which used to say that we need to maintain tax invoices and ensure that the payment has been made to the vendor within 6 months of the agreed date. Similar update has been made for import of goods and import of services. For all import of goods and services, it is mandatory to maintain invoices from the vendor, maintain the proof of payment, or if you're deferring the payment, maintain a sort of a document which substantiate that the intention to pay has developed within 6 months from the agreed date of payment. So those documents have to be maintained, and then only you can claim the credit. There can be a situation wherein the reverse charge is due, and as per the date of supply, your reverse charge is due on a particular month, say in January, 1st January 2023, your reverse charge is due, but you don't have the invoice from the vendor, or maybe you do not have the intention to pay. So in that case, you will be able to claim the reverse charge, the input tax on this reverse charge mechanism in the month when you actually get the invoice, or when you actually make the payment, or when the intention to pay is developed. Additionally, for import of goods, customs document have to be maintained and retained. So there could be scenarios wherein reverse charge mechanism may have a payable liability if invoices are not there, if custom documents are not there, if intention to pay is not there. So this could have a far-reaching implication on all businesses. Mainly service providers who are like IT service providers, they generally do not provide invoices. There is an auto debit which happens from your bank account or your credit card, and you just book the reverse charge and you claim the input tax. This will not be able to sail through now. We'll have to make a mechanism wherein uh, we have to get the invoice from the IT service provider located outside UAE. Anurag
Yeah,
sir.
yeah. So this provision itself, I mean, very, very great importance to everybody. I mean, it applies to all the businesses out there. Now, what happens? There are always scenarios that we are taking a lot of services from overseas parties out there. When we take services from overseas parties, I mean, the payment gets straightway, credited, and we don't have a specific invoice, from them. And then what happens is just a receipt that is coming out there, and you taken that as a base, and you do the reverse charge mechanism in that relation where the invoice is not there. Now that can challenge your claimability. That can challenge your claimability with respect to claiming of input tax. That is number one. Number two, take a scenario that we forget. I mean, we'll discuss that provision when it comes to further a little bit about the audit and other stuff. But take a scenario that you've taken a supply from overseas parties out there, and you forget. You taken service, you made the payment out there. However, you forget to report that in a particular return in which the service was undertaken, and you got invoices as well. And subsequent period, let's say after 2 months or 3 months or 4 months, you've taken that invoice. So now what you try to do, that you try to do book that invoice. Where exactly you're going to book that invoice? Under reverse charge, because reverse charge does not create a the payable tax. It doesn't change the payable tax itself. So basically, you can't do the voluntary disclosure. When you can't do the voluntary disclosure, how will you gonna adjust and take the input VAT in this situation? You can't take input VAT because you can't go and change that return. So what may happen effectively from 1st Jan 2023 is that you will define your output into a one tax period. And the moment you define output in a one tax period, it means your tax liability increase. And then you may, because since you did not settle the output tax, there'll be anticipated and inclined penalties in relation to that. Whereas your input tax credibility, input tax conditions are met after, let's say, 4 periods. So in between the period in which the sales were supposed to be reported, outputs were supposed to be reported, and the period in which the input claimability get applicable, there's a difference. So in this difference, you may have to pay the penalties out there. And then there'll be two tax period which you need to modify in terms of voluntary disclosure in that relation. So, from a reverse charge perspective, please consider it very critical. And essentially, the parties who are dealing, let's say, social media players out there are multiple, service providers where exactly they issue invoice from outside parties. Um, you need to have a watch on such kind of transactions and ensure that they are recorded and proper documentary proof have been taken into consideration, because this can really impact in a bigger way. It can really impact in a bigger way without having an understanding of it.
Correct. Yes, I really agree that this may have implications on every business. Moving ahead, there is a sort of a clarificatory uh, amendment wherein they have said that government entities can recover input tax credit for sovereign activities they have provided. There is the inclusion that they say that charitable organizations can recover input tax credit for the relevant charitable activities. So by charitable organizations, we mean registered designated charitable organizations who are registered with the FTA. However, claiming this input tax credit is allowed, but they should ensure that these input tax credit are not blocked credits or input tax credit related to exempt supplies. That is the general rule which is there. So this amendment is basically clarificatory in nature, and this gives the power to the government entities to recover input tax credit for the sovereign services or the sovereign activities they have been providing.
I think it is important provision for businesses which is dealing with government. So we have seen a number of scenarios where the businesses have a contract along with government entities, and that price that they have entered along with government entities was inclusive of tax before. I mean, it is like many contracts have been entered before in such a manner that before 2018. So in 17 they agreed a contract and it is ongoing itself. Now because of this particular contractual condition, the business were not able to charge VAT, and some of the companies, some of the entities were not accepting that. Now, with this particular clarification, they can go back to the authorities out there and say that, look, you are now permissible, and although you are permissible, it is much more clearer in the law that you are able to recover the entire input. So the businesses have now freedom to charge VAT as well. I mean, though they had before as well. It's a matter of clarification, but it is now well clearly clarified, so you can now charge. So businesses who are dealing with government, they can now take this clarification and renegotiate again the terms of the contract along with them.
Agreed. Thank you, sir. Now moving ahead, there are few amendments which may have implication from IT perspective also. There could be some IT changes which are required. Tax credit notes, earlier there were four reasons why tax credit notes could be issued. Now there is an addition that if there is a tax charged in error or if there is a tax treatment applied in error, you may issue a tax credit note. If suppose you have made a sort of a blunder in applying the correct tax treatment, you can still issue a tax credit note and rectify the transaction. The remarkable change over here is that the tax credit note also has to be issued within 14 days from the date when such condition was satisfied in Article 61, which is the occurrence of issuance of credit note. So within 14 days, the credit note also has to be issued. Previously, what we used to see that the clients used to defer the credit notes and issue it upon their will and fancy. That has to stop. And whenever there is a condition which is being met, or if the instances of issuance of credit note has been met, within 14 days from there, a credit note has to be issued. The systems also need to be integrated in such a manner that timely credit notes are issued and compliance is taken into account for the credit notes. Alright,
Now,
sir.
this has a very important, it is very important clarification, and um, businesses should not consider that this is a way out to adjust your tax liabilities and correct the error. Now, what does it mean when I say that they say that 14 days from the date when the condition was for issuance of the tax credit note was satisfied? What does it mean? It means that, let's say, somebody has done a tax error in 2018. Can he issue the tax credit note today? He identified this error today. Can that happen? It cannot happen because the conditions with respect to that was fulfilled in the respective tax period. So you need to go in the respective tax period and issue the credit note, which means it may require you further to modify your tax returns in the respective tax period in which the error was made. It's not that today you can do a credit note and just get away with it. It has to be modified in that tax period. So within 14 days, when the condition for issuance of the tax credit note was fulfilled. So it is very critical that you need to take that into consideration, that condition when it was fulfilled. It means when you issue invoice within that 14 days of that invoice, you should issue a credit note, not today. Right. So that is important clarification, I believe.
Correct. Moving ahead, there are few minor changes in uh, Article 65, wherein it's saying that if there is a tax collected and if there is a tax written in the tax invoice, that has to be deposited to the FTA. This was there in the FTA, but the language change has been there. Further, there's a remarkable change in Article 67, wherein they are saying that for invoices which are related to Article 26, that is the date of supply having consecutive invoicing and periodic payments, the tax invoices for them also can be issued within a span of 14 days. Previously, invoices were being issued on the particular date which was specified in the contract or when the payments were being received, but now the FT has given a window of 14 days to issue the tax invoice for supplies made under a continuous supply. Number one point which is supposed to be noted is that liability for reporting in all cases will be there in the same tax period, even if there is a 14 days period to issue the invoice. Suppose like if you are making at the date of supply has triggered as per Article 26 on the 31st of January 2023, and you have a window to issue invoice within 14 days, but the liability has to be settled on January tax period. Anurag sir.
Yeah, so you can essentially like what happens if the previous period is there. So in the invoice, there's always a space for reporting that the time of supply. So your document can be dated today, but then you need to mention about date of supply is in the period in which it was applicable. So date of supply can be out backdated. However, then the document that you issue can be current dated, but then it doesn't stop you from reporting in the previous period. That's how you should be doing it.
Correct. Okay, so there is a new article which has been included, 79 bis, which is speaking about statute of limitation. The main criteria or the main condition for audit is specified in the tax procedures law. That is, the general rule is there wherein the FTA cannot conduct audit or issue assessment orders after the expiry of 5 years from the relevant tax period. However, there has been few clarifications which have been brought and few amendments in the law which will change the audit timelines, and the periods would be different now. Now, this change shows that there is a seriousness from the FTA in respect of tax compliances and tax audits. There is one change which has come that says that if the audit has notice has been issued before 5 years period, that is before the limitation period, if the audit notice has been issued, the audit can be concluded within 4 years from the date of notice. Suppose we are in 31st of January 2023, and for the period of March 2018, a tax notice has been sent for audit. The audit should be concluded from March 18 by 31st January 2027. So effectively now the government has 9 years. They can issue a notice within 5 years, but they can conclude the entire assessment within a span of additional 4 years. So this gives them a lot of time and space. Generally for excise tax, we have seen that this amendment came in 1 month back for excise, and because their excise tax was implemented on the 1st of October. So most of the clients, 1st of October 2017, so most of the clients got the notice on September and October saying that we are initiating an audit and more details will follow. So we can expect that few industries like insurance has already got, most of the insurance players have already got audit notice, which they can be concluded in the span of 4 years. So we can expect that few other industries will be reviewed and audited in the future.
I think Gaurav, this is a good provision. I think what happens, it brings accountability of FT also to conclude a particular audit. At the same time, they reserve the right to serve a notice of an audit and then conclude that within the 4 years time. So essentially, they got 9 year window, to complete an audit, which means the taxpayers have 9 year window to substantiate and maintain the record completely. So while we see that the year is approaching out there, and so first period with respect to 2018 is away from the site. However, if the notice is received, and then one period is still continuing, so we have 9 year window in which the FTA can continue. They have a right to continue to conduct the audit, subject to they serve the notice before the end of 5 years. So it brings more sustainability, and it brings more seriousness and control by FT over the businesses in terms of the tax. Yeah.
Correct. Just to add about the statute of limitations, there has been more clarifications provided that voluntary disclosure applications cannot be filed after the expiry of 5 years from the end of the tax period, which means that if we're sitting in January, 1st January 2023, we will not be able to file the voluntary disclosure for January tax period 2018. So if companies have made errors, or if they want to rectify the errors for January 18 or so on and so forth periods, they need to do it as soon as possible, just to ensure that the statute of limitation does not apply to them. Second thing, for the fifth year, that is 2018, if there are voluntary disclosure applications filed, the FTA can audit and issue assessment orders within a span of 1 year from the date of submission of VD. For example, like if for 2018 is the fifth year now, if we consider, for fifth year, they have 1 year to issue and review the voluntary disclosure applications.
And they
Apart
can
from,
further here.
yes, sir, yes, sir.
No, no, go
So
ahead.
yes, okay. So apart from that, the statute of limitations can be interrupted by the civil transaction law. And if there is a different limitation which has been mentioned in the tax procedure laws, it will not be applicable. This UAE VAT law will prevail over the laws, which has been clarified by the FTA. There are two other cases, like if there is a person who was required to register and they did not register, the FTA can come and conduct audit within 15 years from the end of the relevant tax period. For tax evasion cases, same provisions are there for 15 years. And seeing the surge of audits, we envisage that more provisions would be added in respect of audit, and more clarity will be provided. So if we see that there's one more thing for real estates, we have to maintain a books of accounts for 15 years. So if the tax non-registration and evasion case is similar as maintenance of books for real estate. Anurag sir.
I think important provision in relation to the VD is that whenever the VD instances we've seen lot many in case of refund situation. So if the businesses are continuing to have the refund to be set up against the future dated supply, the moment 5 year period ends, and if the refund review envisage a voluntary disclosure to remove a particular blocked input, there may be challenge because you will not be able to do the voluntary disclosure. In that situation, your refund may be rejected because voluntary disclosure is not there, or probably then you may be subject to the further provision of the audit in which the FD can envisage further strengthen penalty on the business itself. So the businesses which in the refund situation should ensure their refund is claimed and settled within the period of 5 years. That is number one, because of the condition of voluntary disclosure. So how I see that essentially. The second thing is that the people who have not registered, for example, many people, many businesses are there, or many individuals are there, which is performing services and they are getting the money in their personal bank account. They never thought of registration, and then over a period of 1 year, they realize that their money that is coming to the bank account in form of, let's say, commissions, in form of certain ancillary services that they're performing, or in their independent capacities, freelancers, people out there, they need to be very careful because how you see that records are there with banks. So if FTA wanted to have the control over the records, they can always approach bank and then they can provide all these things. However, in the UAE at the moment, there is always a situation whereby the banks, they keep the records for an active account for a specified number of periods. So that need to be seen, that how the central bank and FTA will align together in order to retrieve the banking records. However, they tighten the bit. They're tightening. They're trying to put together a situation whereby they have the complete control over the tax evasion scenarios where they're possible out there.
Yes. Uh, just moving ahead in paucity of time, just moving ahead, there are few slight changes in language in Article 74, 76, 77. which may do not have much implications. So we will circulate the entire update once again with everyone, so you can go through it. Moving ahead, we envisage that a new Imara tax platform will be implemented anytime in November and December. It's in the finalization state. We have done the testing also with the FTA. We were fortunate enough to be a part of that. And we envisage that this Imara tax will be an integrated website wherein the e-services will be no longer be there and Imara tax platform will come into picture. This, like Anurag sir was saying, this Imara tax is integrated with all government organizations, and the integrated informations will be there. Whatever documents are there with the in the previous e-services will be migrated to the Imara tax. Apart from that, we would request you to ensure that the email IDs are working for the previous e-services and all documents are updated, because we have seen that FTA started levying penalties for non-updating of trade licenses and non-updating of Emirates IDs and passports of authorized signatories. So this has been started because they are moving to a different platform right now. So it's better that updation should happen. Anurag sir.
I think many times when we look into our business and we're very careful about on the transactions that whatever the transactions that we are doing and whatever transactions we are performing out there, we are very careful about it and we try to ensure that compliance with. However, when it comes to portal, we have seen with businesses out there that they never revisited those. So basically, the power of attorneys, they have been expired. The licenses have been expired. The Emirates ID have been expired. Maybe the change of manager have done. Maybe change of address have been done. Business, maybe the clubbing of licenses, change of shareholder has happened, or whatsoever changes are brought within the business that is not updated on the portal. Now, as per the penal provisions of the administrative penalties, this is subject to the penalty. And we've seen some cases out there where people reach out to us that look, we have been levied with this penalty and let's file the penalty waiver. I can tell you, friends, that whenever there's a penalty of any administrative nature, there is no relief in that relation. The relief is always in case which is in term of the penalties that have been applied in relation to delay. They may be considered, but administrative penalties, which is purely in nature of non-compliance, there is no liaison. So you may be very careful. You may want to be very careful with respect to the scenarios where these kind of things. You can update your records and just be compliant with respect to federal tax authorities regulations in that relation. Yeah, and and going forward, Gaurav, can you please put next slide as well?
Yes, sir. So moving
So
ahead, we have seen that there is a change in the payment mechanism. E-Dharam is no longer there from 30th October, and a new Magnati scheme has been introduced, wherein the charges of service charges have been drastically removed from 2 to 3%, which the credit cards used to charge, to 0.714%, and that's a good move by the FTA. Sir.
yeah, I think this is a very good move because a lot of businesses sometimes, especially the SMEs, they don't have sometimes cash flows in a particular tax period. So essentially, when there's a quarterly tax period, so they can now pay using their cards or in a situation like that. So they have been updated with rates, which is pretty as per standard. So I think this is a good move by Federal Tax Authority.
Readiness for the new platform. There will be automatic integration. I'm just running it through because I know we are over time now. There will be automatic integration of the data which is there. This will be one platform for excise, VAT, corporate tax, and other federal taxes which are to be levied. It will be interlinked with all the government portals. The compliance process may change. There could be upload facility for returns and documentations, others. There will be continuous review and communication chats and will be launched in that platform. UAE pass would be required in the login process. So that is what we envisage. And there is a OTP driven uh, filing of return and OTP driven submission of declarations. sir.
I think very important provision in that this relation is that as we all know that globally there's an e-invoicing concept, which is like Saudi is anyway implementing it and implemented e-invoicing. India has, many other countries have e-invoicing platform. Also, most of the tax authorities, they allow the taxpayer to directly integrate this system along with it, which is like, your return is produced through your book entry and your system can produce it. Then tomorrow, the system itself can integrate and take the entire schema, like we do in CBCR, the entire schema can be uploaded on the platform, automatically by using, XML scheme or whatsoever it is. So there are further strengthening on the technology part in order to provide ease of connecting the businesses along with FTA directly on that side of things. So I suggest that businesses should look into upgrading their tech in order to ensure that your returns are basically verified, analyzed and summarized in a very effective manner by looking into all sort of rules and regulation, so that the small clerical mistakes can be avoided, and then the same return can be replicated back to the authorities portal itself in due course. So I envisage that a lot of technological development that is coming out here, and businesses should start looking into now, because it's a quite lengthy process in order to streamline the tax automation. So if you start today, you can look into that entire automation project over a period of 1 year, where you can see all the nuances. Like, for example, when we review a return, there are 75 to 80 criteria that we look into a particular tax period. Now, those all 75 to 80 criteria can be automated to a greater extent. So if you start looking into your automation today, probably effectively over a period of 6 months to 8 months, you have all those scenarios embedded into your system, and that system can continue to validate the transactions on three critical criteria. So one is accuracy. You can define that accuracy based on industry. The completeness, right? And third one is cutoff. So accuracy, completeness, and cutoff, if you take care of those, your return will more likely, compliant along with the provisions of the law. So if start looking into your automation perspective now. And before we conclude, I'm sure we all are waiting for to conclude, but I want to share one very important, small stories. Like, whenever I do and talk about it, I share one generally story. So when we talk about this one scenario in this very small provision was there with respect to the consideration in respect to payment for vouchers. So the vouchers clarification was there, a very small provision they made that in relation to the supply, So if you're going and buying a particular gift card, let's say, and somebody is supplying the gift card to the people. So what is the supply? If we pay consideration above the advertised price. So let's say take example that somebody is selling a gift card along with any other products. So the consideration is always above than the advertised price, because you have multiple supplies in relation to that in that particular invoice. So until now, it talks about the consideration in excess of advertised price, but it does not say that in relation to the gift card or voucher. So now FTA added a very small word, in relation to the gift card. So when you talk about the money in relation, how do you determine the consideration is in relation to a specific supply? So I was thinking about it, what does in relation mean? So I went on research a little bit about it, and I found one very important case, and which will be very, very important. You will laugh as well. So some point in time when we learn, we should look into that. What that case. So there was a case called Dutch potato. So what was happening? The Dutch authorities in later 19. So there was an association. What it was doing that. So association was like these cold storage. So that association was providing the cold storage facilities for all the potato producers. And then this association was having, obviously every member was part of it. So they were having a share value into that. So what happens during some years, the association did not charge all the association members for the storing of these potatoes for 2 years period, effectively 2.5 years period. So what happens? There was no supply. There was no supply, so there was no VAT that had been charged. So Dutch authority went out there to say this: look, there is a there's a supply because the people have stored all these potatoes in your cold storage, and so the association asked you, what is the price for it? They say over last 2 years, your share price have been falling down. You know, your share price have been falling down. So what is a decrease in the share price is commensurate as price for supply. So it's very, very case. So the court went out there. Court says that look, we need to see the relatability of the consideration in relation to a particular supply. And then they say, look, price of the share is not controlled by whether you charge or you don't charge. The share price falls because let's say revenue, and revenue has many other criteria besides whether you charge or not charge, right? So the consideration should always be in relation to a particular supply, need to be established. And these kind of cases help you out to understand what is the relatability of the consideration and to supply. So it was very interesting case. I thought to probably share with you that in relation to voucher, what does it mean? So yeah, Gaurav, go on please.
Yes. So, as a conclusion, there are a few areas to focus on. We should start preparing for the audit workings, maintain the files for 5, 9, 15 years, as the case may be. Documents should be appropriate and sufficient. Refund planning, or like Anurag sir was saying, that we need to plan our refunds. If we see that the credit is going to expire and it's nearing 5 years, input tax credit should be claimed. And if there is a case where involuntary disclosures have to be filed, it should be done before the expiry of 5 years. IT related changes have to be integrated, like the 14 days criteria for tax invoice and tax credit note have to be embedded. Tax codes have to be implemented, especially for reverse charge, that is for pure hydrocarbons. Since the new Imara tax platform has been implemented, we need to ensure that there are few updates which will be coming and the system is accordingly integrated.
Yeah, businesses start looking into review of their previous returns that they've been filed, because it's essential to correct the mistakes before FT identifies. Because once the tax authority identifies a particular mistake, it goes very intense and the penalties become very significant. However, once you do the voluntary disclosure of after identifying the penalties, you always have a reason to go and seek, mercy from the tax authorities in form of penalty waivers and so on and so forth. And there's always, and we have seen businesses are getting relieved because they're honest taxpayers and they get relieved out there. So if you do your little bit of planning and look into your compliances, I think it'll be very very helpful for the business, and at least you can avoid lot much exposure, on the business itself. So I think probably health checks you can do that. You can look into your technological advancement to avoid mistakes that you have seen in the business happening in the past. So the compliance has a significant cost, and we don't realize until we commit the non-compliance. But we have seen businesses, they are struggling. I mean, the penalties of businesses may range many businesses of like 100 million, 50 million, and then just because a very small amount was not provisioned in that relation by hiring a particular concerned person in the organization to undertake such kind of activities of compliance. People say that, look, this is a cost, but once the penalties comes in, it becomes really, really significant, and then businesses may shutter because of that. We've seen that.
Correct. Correct.
Yeah. So I think now, Gaurav, we can take the questions out there. There are certain questions as well that everybody has, so we can take those questions.
Correct, sir. I think, sir, we are over time. So, since we are over time and people have following meetings, so what we can do is that we can take questions online. If someone has questions, they can drop in a line to us
Yeah.
at info@ae.anderson.com, and we will try to cater to your questions.
So the question that have been put together in chat, so we will definitely gonna contact you and revert back these questions to you on a one-on-one basis, and we'll revert back on those questions. So thank you.
Thank you so much, Anurag. Thank you so much, Gaurav. Thank you for the insights on the new VAT law point by point. And Gaurav, thank you for sort of getting into the details and giving us a perfect understanding of it. And of course, Anurag, your examples are perfect in terms of making us understand exactly how the procedure needs to be put in place. As you rightly said, Anurag, that as businessmen, as business people, as taxpayers, we all need to concentrate on what's important for our business. So if all of you are concentrating on what exactly the business is required to do, you can leave the rest, which is in case all of this becomes any complicated for any one of you, you can surely get in touch with us on our landline as well, or even on our email address, which is info@ae.anderson.com. Post this webinar, we'll sort of surely send you updates of the PDF that Gaurav presented, and we'll also send you a detailed update of the FD amendments, the VAT amendments. So all of you have that in your laptops as well. Whenever you want to sort of browse by, look at them again, and get back to us with questions. You can give us a call as well. And we'll sort of conclude this right now. If there's anything else you guys want to add, Anurag, Gaurav, you want to add anything, please
Thank
feel
you.
free to.
Thank you
Okay,
so much. Thank you so much, everyone, for joining in, and we'll definitely release your answers to the questions. The Q&A will release. We have a number of questions, so we're gonna formulate a document and share with you shortly. Thank you
Surely
so
we'll do
much,
it.
and it's a
Thanks
with
all
us.
of you for attending.
Thank you.
Thanks.